um, we're going to review the open last week's trades. We're going to go over perform. I have to edit these. Obviously, they're a little rough. I'm going to go over position tracking, performance measurement. The model portfolios will be presented to you. None of the. I think most of the names will be familiar to you, but I have them structured in a certain way, and these are models, but they're also real-world recommendations. I got enough questions between this and Options Income Blueprint about a potential market correction. Did you get the update, Dave, by the way?
Yeah, I've got it edited. I'm going to send it out here after the market closes.
Okay. And as you saw in today's update, I was trying to address some of the questions about a potential market correction today. We have our survey to see what you thought of what we presented to you, or I presented to you, and we have a little surprise for you at the end. Let's go over how the trades went. We did, in a sense, we narrowed down the universe of companies I was recommending, because this is in part a profit-making service and a part of coaching service. And I recommended 2 different Gilead positions, a SanDisk position, and 2 different U.S. Steel positions. The Gilead Sciences, I have to fill this in after the close today. What happens if you put the shares? I got an email. I got a couple of emails. Are you going to roll it? I thought I had made it clear, and I regret if some of you missed it, that this was the beginning of a covered combo trade. That this was to collect extra premium to reduce the cost basis of the shares, and the idea was to be put the shares unless the stock skyrocketed and you make a very nice profit, and we're just going to turn around and sell calls. So I'll be putting a call recommendation out tomorrow in an alert. I wanted to wait till the smoke cleared on a Monday, and before we went ahead and committed. It must probably be a weekly. It may be a monthly. This is a change. I was going to put the recommendation in now, but I can't put a recommendation in without looking at the open tomorrow. So the flip side is, Dave, do you think I should put a potential recommendation in here and just do like I've done, go ahead and do it on Tuesday morning? What do you think is a better way?
I think you do. I mean, you're telling me this is because you have enough people from this who got put, right?
Yeah, I assume they were.
So now they were put at 83. It's 81. What are you seeing? 81.40, something like that?
Yeah, something like that, yeah.
So, I probably would do this up front.
Okay, then I'll put the recommendation in tonight, and I'll tell them if I change my mind tomorrow morning.
Yeah, that's all. I can get an email out in the morning easily.
Okay, so the SanDisk $96 put, I'm just putting bullet points in. It closed. We made a lot of money. Let's move on. U.S. Steel, also we will put the shares. The stock dropped a little bit more abruptly than its chart would have shown. It bounced off of 24. But as you know, I'm a big believer in the stock. This is a great way to sell calls. There's wonderful premiums in the call, so I'll put the recommendation in for U.S. Steel as well. So that's the standard stuff we've done the last few weeks. Here comes the hard part. What I want to do is I don't want to look back tonight, but I want to remind you of some of the things that we've collected, and some of you, hopefully, I know from emails and from comments have used, and to show you a way to do all the different tactics, all the different trades that we've done, how to properly measure how they're contributing cash and income and the rate of return on your capital, and how this should all work in a very simple way and in a very seamless way. The thing that's important is, even I really love my online broker, but even when I download their spreadsheets, that spreadsheet is inadequate, because the spreadsheets are really measuring what has gone on in your portfolio and what your portfolio has done in a month or a week or in a year, where it stands right now. And that's important, but we're looking at cash. We're looking at cash more than anything else. And by focusing on cash, you need to build, and I'll go into it in some specifics in a moment, on one of two things. You need to build on your broker's calculator, and most of you probably have brokers where you can download something that goes into a spreadsheet or spreadsheet itself, a spreadsheet page, and you can build on that, or you can build on a position calculator. But what I am promising you is we're going to go over screens in a moment of what my own performance calculators look like. It will be available tomorrow. And there'll be a way to use it as a standalone for a put position or a buy right or what have you, the way the position calculator works, and it can feed back into your overall portfolio, or it can work in a seamless way, in a larger way with everything that's going on. Now, this is what I want to bring you back to. If you remember, and I went over this last week as well, but I also went over the boot camp at length, this is a typical income portfolio, and you can see what was in red, by the way, was the cells that you could input. The black cells here are what would come out from putting your own numbers in, and you saw that if you allocated your capital this way, you were going to end up with about a 5% total return on capital. If you had a fully allocated portfolio, then your total return on capital, which is at the bottom, you can see is much, much higher, and this is what you left on the table. This, too, needs to be measured. The reason I remind you all of this is that we're not only measuring how a position works, we're not only measuring how we did in a week or how we did in a month or even how we did in a year or a quarter. We need to know how well we're leveraging our assets. What assets are being leveraged to produce cash and income? So that's also what makes this fairly unique, and that's something, of course, that's very, very, very straightforward to do. So the building point here, this is a simple put position calculator. This is an old screen from a different presentation. These are the calculators that's available on the website. What you want to do is you want to build on that, and you can take your this, and you'll see this in the screens that are coming up. This becomes the basis of doing sort of the most modest, couple of second analytics on how your position actually performed, and that in turn will feed into a measurement of your portfolio. So, Dave, this is going to be a screen of the position calculator modified, which I'm working on right now, and it's just really it's actually adding just a couple of columns. And then what it will show is that if they want to do a simple performance measurement calculator, it comes right off of what they already have. And it's a different approach than obviously, because when I looked at yours, I really liked yours, by the way, but it was based on broker screens, correct? That was a download from your broker that you modified?
No, I just did an Excel spreadsheet.
You retyped everything.
I retyped everything. I just took the trades right off the alerts and what we did, and then typed it all in there and followed the trades.
Yeah, because that almost looks like my Options Express download, so I assume that's what you had done. So the two approaches, and as I said, I'm going to get this done not in the nick of time. It'll be done, but I'm behind compared to where I have been previous Mondays. This is going to be the extended performance calculator. It'll be the extended position calculator, and this chart's out of position. Sorry, this should be the first chart in the section. I know I'm a little discombobulated. As I said, I'm running behind. So I'm not going to move it around. Well, let me move it around. No, I'll move it around later. Forget that I went to this chart. I'll go back to it. Those two. This is where I was, money left on the table, and I meant to come here. So what I'm trying to tell you is you have income goals. You need to leverage your capital based on the income goals, and you have to push, and you have to be aggressive. It doesn't mean you take unnecessary risks. And there are two things you're going to track as you increasingly leverage all your assets. The first is the value of your portfolio. Even someone like me, emphasize cash all the time. I know what portfolio is worth at the end of the day. Most of us do at the end of the week if we don't trade as much. That's one way that comes out of your income goals, because that portfolio value over the long term will determine the capital base that you have to generate income. But you also have to create something that brokers don't supply and you probably haven't looked at, which is simply the cash generation number that you have in a given period of time, the period of time that you like to track. I track my cash generation, and I mentioned this during the boot camp, in my own portfolio. I do it daily and monthly. I don't look at it by the week. I do it daily and monthly. You may prefer doing it by the week. I know that if I did a survey, probably 7 out of 10 people would probably like to do it by the week. That's fine. That's just a matter of how you do your measuring. But you do need to measure. You do need to measure the cash. And when you're looking at portfolio values, if you look at this chart, the brokers are supplying a portfolio value, and that's what we're used to. We're used to saying I have $257,000 in the account, and yesterday I had $256,500, and then you can click on a broker screen that says analytics, and then you just measure what you did that day, and the two numbers work out because you made a $500 profit today. The cash generation is what you need on top of this, and this is the heart of what we're doing. So what you're going to see in the screens I'll be showing and the calculators you'll be getting tomorrow and Wednesday is really about supplementing what you're probably already using to both measure your performance and specifically measure your performance in cash. Another way to look at this is you need to feed this back into your next trades or your series of trades, or how you focus on a specific name, be it Bank of America or SanDisk or what have you. You've selected, so we're not only looking at portfolio management, portfolio measurement, and income goals, we're looking at your performance and the performance of individual positions. And when I mean position, I don't mean a transaction. I'm talking about if you've decided to trade SanDisk for 3 months or 6 months or a year, how are you doing with that? It's not just the last sale of a put, it's how have I done with SanDisk over the last 3 months. So if you take this from a bottoms-up approach, which we pretty much have been using, you're selecting a stock, and it could be SanDisk, it could be Boeing, it could be what have you. You're creating a position, or positions in plural. There's the performance of an individual transaction. Then there's the performance, and that fits into the performance in a series of transactions. And then every so often you need to review and you go, how am I doing? I've traded SanDisks now. I've allocated $15,000 or $25,000 worth of capital to SanDisk. In the last 3 months, I've generated $2,000. Well, I'm not executing well because that's, well, I am executing well. That's a 32% rate of return. So yes, SanDisk is working. The stock is moving. I love the stock. I like trading it. I'm going to stick with it. This is very simple to do. This is not hard to do. And we'll provide you, as I said, tomorrow, Wednesday, with sort of handy-dandy, convenient ways to do this. You could do it right now if you wanted to, just trying to simplify things for you. So we have the top-down approach. If we look over here, from your income goals, of the top-down approach is you need to create performance tools and measurement tools that are good for you, that measure cash, which you're currently not using. And then you have to have the bottoms-up. You need a bottoms-up performance and measurement of how am I doing with that series of stock transactions. And then you tie it back, okay? And excuse me. Then you integrate the two. You put the two together. You have your income goals, your overall cash generation. Then you're going to go to cash generation by position. Now, what this does, and it sounds like I'm just restating a chart, and I'm absolutely not. Performance up here is about my performance on capital, my hitting my 35% return, my 25% return, my 18% return, whatever it might be. Here, you're taking a look at cash, and what's important about this is a natural way to correct what we talked about last week and actually the week before, but mostly last week. Maybe you've overallocated. Maybe you have a favorite stock that you like Apple, and you've put too much money in it. You might be getting or too little money, excuse me. You might be getting a 35% rate of return, but it's only 2% of your portfolio. So what you also want to do is this kind of analysis by cash, by actually how much cash is it producing, and then again fold it back into the performance of the portfolio and the performance of your name. So you want to look at it as the efficiency and effectiveness of your trading. Are you hitting your percentage income goals? And this is a way to make sure that you're allocating your capital and the stocks and names that you're doing the best with are contributing the largest amounts of cash as they should be. So a little history here I think is important in terms of measuring. I know that many of you are skeptical, and I'm trying to anticipate objections because it's not that I hang out with them, but I know traders. I know people who trade, and they're investors, but they're also traders, and they only look, they think this is the wrong approach for them, and they just want to look at how their portfolio is done at the end of the day. But let me give you a little history. During and after the Great Crash, what did income investors do? Now, it doesn't mean when I say income that you're going to take all this cash and spend it, but this is a cash-focused, income-focused approach. They hung on and they collected dividends. Part of the reason was their portfolios had been savaged, but part of it is they needed the cash and the income. This is the mental model that we need to use for measuring how we're doing. Meaning, this is about long-term portfolio management. How are my great stocks, my growth stocks going to do over the long haul, which is why you always do have to keep an eye on the portfolio, the performance number. But this is short-term cash management. And the lesson that we learned during the Great Crash was I'm going to ignore that I'm down 50%. I'm not going to run. I'm not going to get chicken. I'm not going to liquidate. I need those dividends. And dividends did not go down 50%, obviously, during the crash. What happened during the crash was income investors put short-term cash management over and above the issues of restructuring a portfolio. All they wanted was the cash. And this is our working model, that you are an investor who is trading. So you're investing a portfolio. You're going to measure that. That's what you're currently doing. How am I doing? But you're trading, and that trading is to generate cash, and that is what we're really going to focus on. So here are the guidelines, some of the specifics. You always measure against your initial capital. By that I mean a true trader will always measure the amount of capital they use based on the current value of the stock, not what they originally invested, because they can always trade it away in 5 seconds, so what's it worth? We don't do that. If you buy Bank of America for 15, well, let's say you bought it when I first recommended doing it at 8, and you're selling, you haven't increased your capital allocation. It's just there. It's $8,000 or $80,000, whatever it is. You have to measure your performance against the amount of initial capital that you put into a position such as Bank of America. But you always also have to measure against goals. So those are the two macro level things. You need to track by name. So if you've done SanDisk 12 times, how are you doing with SanDisk? You need to track by sector, and you need to track by type of trade. By sector, it can be your sector, energy, capital goods, foreign stocks, or it can be my sectors, iWorld, what have you. That's really up to you, whatever you're comfortable with. And you need to track by type of trade. And I mentioned this during boot camp, and I mentioned this in our first couple of sessions. Are you better at selling covered calls? Are you better at selling puts? And better is a real term. It's not an ephemeral term. Where am I making the most money? Where am I having the best rates of return? You will see this over a number of weeks and months. So you should try to track by type of trade, and it's really not that hard. Measure your use of leverage, as I said, and don't be lazy. Prepare to type. You can't just download a broker screen and take a look. You're gonna have to do some work if you're managing a 6-figure portfolio and I'm talking minutes, I'm not talking hours, in order to be able to get the data you need to move forward. And as I say, like every 30 seconds, for all my emphasis on cash, never lose sight of portfolio performance. As I said, the broker downloads aren't good enough. We're going to build off the position calculator and the downloads. This is too repetitive. I got to end that. So here's the chart on extending the position calculator. Well, I'll talk to it. As you can see here, this is the position calculator with 3 extra columns. And if it was in front of you, Dave, I'd walk through each column. And what this does is you've done the work and you've done the analysis of why you want to make this trade. And you've made the trade hoping to get, as you can see, a 32.5% annualized return. What you're going to do is the trade's over. And you're going to take the results and you're going to plug them in to the column over here. And then once they're plugged in, you're going to see what your actual rate of return is. And over here, you're going to have the cash number that is the cash contribution to your portfolio. So rather than you having redo everything, we're just taking what you already become familiar with and what we've been using, and we're adding 3 columns. And it may seem a little bit repetitive, but this is the simplest way to do it. And over time, you can move the cells around as you will if you want to shrink it a little bit. But that's the basic thing. We're adding 3 columns here to the position calculator. And all of a sudden, because you're going to put your own number of contracts in and so forth and so on, you will see that you have exactly what you want, and that's the cash contribution. Now let's get specific. The position calculator, of course, looks different depending on the kind of tactic you're using. So this is what you can see here is a buy right. And let's walk through it. You bought Bank of America. This is one of our trades in one of the earlier trading sessions. You bought Bank of America stock at 15.08. I recommended selling it in the money call. We got a quarter, 25 cents for it, as you can see. Cash in, cash out. And then we were called out at $15. Where technically we lost money, so that's why there is a -8. So you have cash in of $25 per contract, and these are all free of commissions. It's the simplest way for me to do this without making it confusing. And this is not a trade you would do actually with one contract. You need 10 or 15 contracts or something to make, well, 5 or 10 contracts to make this trade really work well. So you have cash in of 25, cash out of $8, and you have a net cash of 17. And from that $17 net cash, from this series of these are 3 transactions, you have a percentage return. And as you can see up there in the upper left-hand corner, this took a week. So we divide 50 weeks, not 52, 50, and that's your annualized rate of return. But also, as you can see, we have a net cash number that you can now feed into another spreadsheet that is just managing your portfolio and collecting all your numbers for cash. Now, another thing you can do, and this is 3 different trades, and I hope you're doing something like this for Options Income Blueprint, and from here, this is a simple, this is a simple calculator of puts and calls. And Dave, I'm actually modifying this to add a column that will show the buyback price, which under cash out will be a parentheses, and I'll explain there'll be an asterisk underneath that goes, and then you maybe have purchased this back instead of letting it expire. These happen to all expire worthless. So then you have your net cash. I'm going to add a column over there. And again, just like the buy right, as you can see, we have a net cash number. We have a net cash number here. That again will feed into a portfolio tracker that shows the amount of cash that you're doing. So you don't, have to do a whole bunch, of different things. This is a very easy thing to use. And here is the classic covered combo, which would seem to be complex because it is a series of transactions, but it really isn't. Now, I've highlighted things. The red means you've actually spent capital. Okay, I'm trying to keep this simple. So the term capital applies to using capital to support a put position or actually spending capital to buy a stock. And when you're purchasing a stock, it's in red. And when you're selling a stock and that capital is being returned to you, it is in green. So if you follow the flow, this is a flow of trades. We bought the stock, we sold the call, we collected the money for the call, we were called out, we sold the stock at 15, and then we sold a put. We didn't want to own the shares at that time. We didn't like the way it was trading. Maybe we could do better with a put. We actually sold two puts, but then we decided not to roll it. We accepted the shares. That's why capital went out. Then we sold the call because we have accepted the shares. We generated more cash. Call expired worthless. We generated more cash, and we were called out. So you have all these numbers, and they may seem little. And I've always emphasized, half a point a week, 3/4 of a point a week doesn't seem like a lot, does it? Well, we've generated, this is one contract, obviously, which is low, a little over $100 in cash in a period of a month. Well, oops, there's something missing. There's a chart that has this is actually a 61% rate of return. So I have to add chart 29. So over here, what?
You're not going to show it on there?
No, I could show it on there, and I don't know why it's not there. So I'll go take a look at what I did. But as you can see on a covered combo trade, when you put the whole thing together, you can see how powerful playing one name is. And in this case, if you were trading Bank of America and you had this kind of performance, it should clearly tell you that you're doing well with it. You'd have to check the charts and see how the stock is currently doing. But you should take a look at it, and you should consider trading it and maybe even allocating more capital to it. And this goes to sort of the lab. I'm talking about feeding into the portfolio, but wait a minute. This is where everything was at. I'm sorry, David, it's so discombobulated today. This is that's the position calculator. Yeah, the chart's not there. I actually have it on a spreadsheet. Here, the next chart is missing. Chart 29 is missing. Here we tie it all together. This, not this chart, ignore this chart, Dave. This is actually the portfolio calculator of where we're just assembling cash. And Dave, this is very close to what you sent me this morning. This calculator just lists all the trades. It has the transactions. It's very close to what your broker provides, often in download form. You may be able to download and modify broker data and put it in however you want to do it. But here you can see the contribution of these different trades towards your cash.
Yeah, I'm not seeing that chart. I'm seeing.
No, you're not. The chart's not there. I forgot to put
okay.
it. Okay. That's why we do these dry runs.
Okay.
And it's the chart. It's a simple spreadsheet actually that ties it all together.
Okay.
These three trades, all these results end up on a final cumulative chart. That's the portfolio tracker for that month. So they show how much cash they've generated because the focus here is on cash. And so from there, I walk them through that and I go, let me go back to the chart that I just showed you. Just as a reminder, I can't create this for you. I don't know how many assets you have and so forth and so on. But let me walk through this chart. I've done it in boot camp. I did it 10 minutes ago. I did it last week. I want to do this one more time. I want you, again, to be reminded that you have to leverage your assets and that 4.8% total return on capital is totally unacceptable for an income investor who is trying to be in any way aggressive. What you need to do is you need to take a look at your trades, and I wouldn't do this in a week. I would clearly do it in a month, maybe even a quarter. And you're going to have to spend 10 or 15 minutes with a pencil or a spreadsheet, and you're going to have to figure out how much of your capital you actually allocated and how you did. And do it once a month or once a quarter, and change these numbers in red and see how the return on capital is increasing to keep you from leaving all that money on the table. This is sort of the last thing you need to do in performance measurement. You've measured the performance of your transactions. You've measured the performance that you've shown as a trader and investor in individual stock. You've kicked that performance back into how your overall portfolio is doing. And now you want to take a look as how do I make my portfolio perform even better? Let me take a look at what Schulman was saying about leveraging my assets. Am I really leveraging as well as I should? And maybe this is an exercise, as I said, you do after you've evolved your portfolio, and you do it every 90 days. So let's just review. You are extending either your broker data or you're extending the position calculator. You're doing both. You're going to obviously use calculators. That the spreadsheets or the pencils, whatever you want to use, are a little bit different for buy right than they are for a put, than they are even for a covered call. Because in a covered call, the capital is what you initially paid for the shares. You're going to have those spreadsheets produce a net cash amount that you've produced in that transaction, and that'll go into a portfolio calculator that will tell you how much cash your portfolio is generating, and from there you'll see how your rates of return are doing. That cash number is, of course, tied to but different, almost independent of how you're going to measure the actual performance of the underlying equities, and you have to move forward with those two different numbers. Now we go to two model portfolios, and there are going to be no surprises here. These are investment portfolios. This is as if it's 1980, and it's an old-fashioned newsletter that you got in the mail, in that this is for long-term investors. As I said before, we are investors that trade to generate cash and income, but we have a stock-picking fundamental approach. So in many ways, as you know, I don't have, and I never have in any newsletter service I've ever done, and I've been doing them for 14 years, I've never had a model portfolio. But I felt it was very, very important to develop one that combined stock fundamentals, stock performance and behavior, availability and liquidity of options, including weeklies, and the premiums on those options. That's a lot of work. And I wanted to help you get jump-started, not to start with looking at the premiums, not to start with your favorite stock that has no liquid options, but I wanted to help get you jump-started into real-world trading when this program ends it. But this is not a list of trades. These are not trades you're going to necessarily go out and do tomorrow morning. You could, but I'm not. The model portfolio is about the stocks, and you'll see in a moment some specifics about them. And as to repeat from last week, and to repeat from the boot camp, more calls, more stocks in the larger portfolios, more puts, more cash, and more flexibility in the smaller portfolios. And these come from my bullpen, which is 25 stocks, and I have a prospect list, a hot prospect list of 50 companies in addition to the bullpen. So it comes from a universe of approximately 75 names. And just as a refresher, these are the guidelines for the structure of the $100,000 portfolio, roughly what the percentages in the allocation of capital should be. And here's what I think you should take a look at first thing tomorrow morning. Whether you should own it or rent it. Owning it meaning owning it outright and selling calls, or selling an in-the-money put, or a put that may not be in the money but you think will be in the money by the time the stock comes down to where you want it to be, and then you end up owning it. Or a stock you can rent, meaning you're mostly selling puts against it, and it's not a stock that you're committing a large amount of capital for, or capital for an extended period of time. Seadrill, we've spoken about, offshore driller. They have a big dividend coming. It's $1 on a $37 stock on June 10th. Tesoro, refiner, Pacific Northwest, benefiting from fracked oil. Apple, big developers conference tomorrow. It starts. A lot of movement in the stock since it announced the split. The split's coming, I think, within a week or 8 days. General Motors, very strong product line. The dividend's creeping up. It's now 3.5%. And a really good stock to sell puts against. If you want a dividend that's small and you think it's big, that's fine. You can own it and sell calls. I personally own Seadrill. I personally own Tesoro. I personally trade Apple. I personally own General Motors. I personally own Gilead, which you're all familiar with. Sovaldi is the catalyst here, the Hep C drug. Blackstone, I own it. The catalyst here is they have a nice dividend, 4.5%, but they have a huge portfolio of residential housing, and they're the primary shareholder for 2 new IPOs, La Quinta, Motor Inns, and Hilton. And these are going to be monetized. Those big 3 giant blocks of assets will be monetized, and some of them will be put in the form of dividends, which will push the stock price up. Sprint is probably not worth its share price, except that someone's going to take them out. They're either going to merge with someone, they're going to be taken out, just because the way of the world it's going in telecom. And the recent DirecTV AT&T deal has put a floor sort of under the prices of all telecom companies and all cable companies. And you can have fun with it. It's a $9 stock. There are huge premiums, gigantic premiums relative to capital on Sprint if you commit to a large position. Illumina, as you know, our first trade, paid for the service if you bought a couple of contracts. Great company. It's already moved up from about 138 to 160 since we first started looking at it a month ago. It owns the genomic research equipment and database market. Sarah Wireless was a contribution from a member. It came in one of the first Q&As. I was familiar with the stock and it had fallen off my radar. I like it very much for puts. Nice premiums, excellent spot in the marketplace, grossly undervalued stock. In this size portfolio, where you want to be flexible, that's why I'm recommending a put and that you rent it, but there's no reason you shouldn't own it. SanDisk, I own, great company, NAND flash memory for mobile devices, owns the marketplace, is in great position. When we first looked at the stock, it was 78 or 79, and a month later it's 99, or 96, 97. So you can tell that we're onto something here with SanDisk. The $250,000 income portfolio, again, it's a different allocation, a repeat from last week. More dividend stocks, more stocks in general, and just not more stable. It's just there's more equities in here, and there's a longer-term commitment in terms of the transactions if you have a larger portfolio. And this is, you can print this out, you can download this. This is smaller print. I'll go over the ones we just haven't discussed. Verizon is a stock we've traded. It's a wonderful stock to get 20-25% a year from. It's very, very stable. Great play on mobile bandwidth. Nice dividend, and just it's a great stock to do covered combo trades, as you can see. Starbucks is also a great company to do a covered combo trade. They'll probably be raising prices soon because of coffee problems, coffee crop disease problems, and those usually help in terms of earnings and revenue and so forth and so on. Every time people say it's got to slow down because someone's doing this competitively or people don't have enough money, they basically put the critics on their back. Excellent price point right now. My children each own 3 shares, by the way. It was a present from a long time ago, just for purposes of disclosure. And the bottom line here is it's a very good stock to trade. We've spoken about Gillian. Boeing is about 130. It's just going to be printing cash now that the Dreamliner problems are pretty much behind it, probably for the next 5 years. They don't hit another major development cycle and giant capital commitments for another 5 years. And they're increasing their exposure to the drone business because some of their military aviation business is going away. And very, very, very nice premiums right now if you took a look at them, if you did a buy right, or if you sold a put. ADM, a stable company, sort of in the agriculture business the way Verizon is in the mobile bandwidth and telecom business. Big daddy in corn, big daddy in grain processing. It's not going to double in price in 2 years, but you can get, it has a very modest dividend, but you can get 20-25% returns with very aggressive put and call trading. Even the stability of the shares, one of the values when you have a stable stock that doesn't move around too much is you can sell in the money puts that have really fat premiums, and that's true for Archer Daniels Midlands. We've spoken about Blackstone, we've spoken about Sprint. Fluor is one of the companies that's benefiting greatly from 3 things. Well, 2 things. Fracking and the Renaissance in American manufacturing. They're an indirect beneficiary of fracking because fracking is leading to a renaissance in American manufacturing, and they're a direct beneficiary because they produce power plants for a lot of industrial complexes, and there are a lot of large industrial complexes now in the planning stage. They have shockingly good premiums on their puts and calls for a stock of its size. It's about $75, and because it's a very stable company. We've spoken about Illumina. Williams-Sonoma it's just a straight put play. Nice, rich premiums, a very fine company. Its market is expanding, as you know. I call it the new American kitchen. They have a whole new audience of people who are shopping there, and they're outperforming most everybody else in retail. SanDisk I've spoken about, and GT Advanced Technologies, which some people would think is speculative because the movement in the stock has been based on their contract to supply what is known as sapphire glass for the next generation of Apple phones. Apple's made all its progress payments that they're required to, which means the factory is working. It should go to full production this summer. If it goes to full production on schedule and they hit their forecast, which management, they missed earnings last quarter, but management committed to their full year forecast. It's a grossly undervalued stock, but right now, because of the volatility, the fun way to play it and generate a lot of cash is to sell puts. Once you get familiar with it, because it's a name we haven't really discussed a lot, you may want to do some buy rights on it because there are very large premiums on the puts and calls. Any questions, obviously, tonight, send me emails. This is what I would look at if you were creating your own bullpen tomorrow morning. But remember, these are still models. The tactics and trades are up to you, as well as doing the simple math that we've discussed. The focus that I have in these models is on the stocks and the performance of the companies, not on the specific option you can sell next week. That being said, these are suitable for almost every kind of tactic that we've discussed, and with a couple of exceptions. I mean, Archer Daniels, Midland, and Verizon are not. They have nice premiums. They're not volatile enough to go in and try to do big daily cash call trades, what have you. But most of these have really liquid options and have really nice premiums. So this set of companies represents everything from their fundamentals as a company to the liquidity of their weekly options. It's the entire chain of components that we've discussed for the last month and a half in one model portfolio. And I've made sure there are several dividend stocks that are part of the mix. I have a couple of favorite dividend stocks that you really can't trade the way we trade because everybody's onto the trade and there's no money to be made. But the Seadrill, for example, is a very nice dividend stock that's in the mix. And remember, these are guidelines. We're almost done with the program. These aren't rules. You're going to have to go off on your own and modify things. But these are good to go right now if you wanted to take a look at a name that you wanted to start trading tomorrow morning. A quick 2 minutes. A lot of emails in Options Income Blueprint and a few from you folks about the market correcting. It's the reason why I wrote about it today in the update. I just wanted to repeat in case you hadn't read the update. This is what you're reading. The market must correct because it's long overdue. It hasn't corrected. The Fed must change course. Valuations are too high. You can read. I hate reading my own charts. Economy's still weak. Bonds must come back. And just listen to all the guys on television. They must be right because they're on television. Trust me, I'm on television. Well, I was on television. It's a waste of time. And you're not necessarily right all the time. I was, but nobody else was. The market must correct. It's long overdue. No one ever says why. Remember, bears are always right, or people calling for correction, because if they wait 5 years and leave huge profits on the table, they don't talk about that. They just say, well, it finally corrected. There is no logical reason that the market has to correct. It's a technician's belief that it needs to correct because of market dynamics. The Fed must change course. It won't. As I wrote, Ben Bernanke has been having lunch with people for a very considerable sum, and he let his opinion be known, and his opinion really still reflects the opinion of many of the people in the Fed. Interest rates are not going back to what we saw before. They're going to be low for many, many years, and that's almost a perfect environment for equities. Valuations are too high. They're not. We're in the middle to the middle up range of traditional valuations for the S&P 500, and when measured against bond yields, there's no history at T-bills at 0.25%. So you can argue that the market's undervalued based on the relative value of bonds. The economy's still weak? No, the economy's not weak. The fundamental underpinnings of a permanent rebound in proper housing sector, real American manufacturing resurgence and renaissance, and we'll be energy independent in 5-7 years. All the fundamentals are exceptionally strong in the economy. Employment is still weaker than people prefer. It's the headline and political issue, but the economy itself is better than practically any other Western or developed economy outside of maybe Australia or New Zealand. Bonds must come back. Well, I only make the joke when in our lifetime. If you buy a bond now and it's yielding 0.25%, as soon as interest rates do go up in the next few years, the bond's going to start to lose value. Bonds are in a terrible position. They're a terrible investment. It's a really bad use of money for ACK land bidding, not just because the yield is so low, but because the potential for a wrecking of the capital base of the bond, if and when interest rates do go up, is terrible. And I prefer Bloomberg Radio to CNBC. And if the market corrects, what do? And I'll walk through this again, and it's just like the update. And the bottom line here is there's a beauty in fear, because when the market gets fearful, volatility increases, we can start using good until canceled orders because the premiums are higher. We don't have to wait for them to expire. We can be actually much more efficient and aggressive in our trading. We can turn monthlies into weeklies because of good until canceled orders. What I mean is you sell a monthly a month away knowing you're going to close it in a week if the market volatility continues. I believe that we're setting up the next leg for the next leg up in the market. And what I want to do, Dave, is this is the teaser that you wanted, and I didn't know how to word it, so I'm really glad you brought it up. And what I want, this is the I'm beginning to wrap up. I'm going to be closing, ladies and gentlemen, but one of the things I wanted to do is let's segue, let's put two pieces of information together. Last week, the last live trading session, I threw out a tease. I threw out a different kind of trade that we'd never discussed to show you that now that you have the foundation, there are a great many more things you can do. We haven't scratched the surface. We've gone well below the surface in what you can do, but there's a lot more that can be done. But imagine if the market goes down. We've sold a leap. You could have bought a leap for $9 for U.S. Steel last week, a $15 leap. Well, imagine if there's a correction and U.S. Steel goes down to $20. Well, you can buy that leap for $5, and then you can sell calls against it. And let's say the stock rebounds to 24. Now your leap is worth 9, and you had a gigantic capital appreciation. So instead of your stock going from 20 to 24, which is a 20% gain, your capital is going from $5 to $9, which is an 80% gain. And we don't have time to go into it, but this is another benefit almost of a correction. If there's a correction, what you want to do is you want to start looking at what I teased about last week, or I gave you the calculator, is you want to start looking when you draw a line in the sand in the market of when to do this kind of a leap call. And as I said, I'm putting this out there for you to start thinking, getting ready to be even more aggressive than we have been here. And then I'll go into trade recommendations. This is too fucking long.
Right. Yeah, I don't think you need to.
The bear market stuff, I don't need it. No, I'm going to cut it out. It's just too goddamn long.
Yeah.
Okay, that's done. And
now you want this to be about the model portfolio, and then questions on stocks, your ideas for stocks you're getting.
And I'm also going to simplify you know me, Jen. I can draw angels on the head of a pin. I know it's one of my weaknesses, and I've been trying to design a spreadsheet, and I'm doing a little mea culpa that people just have to type in like 12 things or 6 things, and everything comes together, and it's too complicated. So I today and yesterday, well, mostly today, I was simplifying it, and I'm going to even simplify it more by 7:30. I'll have to rush my dinner, and I'm going to simplify that section and change the sequencing. It was a little out of order in my own mind, and so it'll be faster. And it'll be much simpler. And most people don't need a performance calculator. I want to focus on leveraging their assets because of your and John's reaction to leaving 48,000 on the table. And I want to focus on how to analyze individual positions and do net cash because it's the one thing that they probably are lacking in terms of handling an advanced trade. But that section will be cleaner out there. I'll kill the whole bear market stuff. Potential trades, I'm probably going to do one. In addition to the 2 call recommendations. It's not SanDisk. These are placeholders. I had to go to see how the market closed. It'll be the typical 5 minutes on a potential trade. Now, here's an important part. The survey. Do you want to introduce the survey now, or you want to email it to them? And just what do you want?
No, you're going to, John will put the link in. He'll put a link in there and leave this up he'll probably do it as you're walking through, so you need to give some time, because here's the deal. Last time, it takes a few minutes for it to pop, or a few seconds for it to pop up, and they got to look and see it. John will direct them to it, and then they got to click on it. Once they click and open, it'll take them to another page, and they'll still be on this page.
Okay.
If they don't do it, we're going to send out a reminder tomorrow, and again, John will say that too.
Okay.
So they'll get one in the morning.
Okay, so we're going to give you a survey. We want to know how we did. But you know what? and I sort of knew this, obviously. I knew this starting last week. I think we need to get together again one more time. And I want to get together on Thursday. I want to do a couple of things on Thursday, and this was a tentative chart. I want to review our June positions. There are June positions outstanding, and they're going to be there when this program is over. I want to review the survey results, but I want to review 2 sets of survey results. What I'd like you to do before Thursday, we haven't had a homework assignment in a while, is obviously I'd like you to fill out this survey. But I also want you to take a look at, remember, you scored yourself, and you, in the first night of the boot camp, you did surveys, and you did surveys, you answered questionnaires, really, on your risk tolerance and on your experience and your readiness to trade. And I'm not suggesting you send in the results to us, but I think it would be very good for you, either before Thursday in order to ask questions or give us feedback, or after Thursday and then send me an email. Take a look at those questionnaires again, maybe even fill them out again, and compare your scores. And I think that would be a very useful exercise, because I think if you've absorbed even a modicum of this material, you're much readier to get much higher returns from a series of trades, and you're also readier to do even more advanced and aggressive positions, such as the leap call position that I've mentioned. And the other thing, Dave, is I was thinking of putting in a couple of final trade recommendations in place.
Well, okay, well, back up. We normally do a weekly live trade, so we haven't even talked about that.
Well, I didn't know whether to do it because.
And you're making this last session sound like work, and that's rather than a bonus section where I'm going to introduce something to you really fun and cool.
Okay.
And again, that's why I want to keep it short. It doesn't have to be a long one.
Okay. Here's the idea. I'll kill the whole thing. Well, we'll review the we'll forget the survey results. We'll review June positions, and what I'll do is I've always said that 2 weeks before monthlies, on a Friday or Monday, the best time to trade monthlies. So I'll put on 2 new trade recommendations for June monthlies.
Okay. Yeah, and special trades. I mean, this will be special trades. We'll do this Thursday night.
Okay.
You can execute on Friday.
Okay.
And I'll take any last-minute questions at that point. But I think that's the bonus section. You can still do a daily live trade if you want to, but I don't know if we have anything else you want to do.
No, so, I'd rather do those monthlies. I don't want to do a live trade tomorrow, and Thursday twice in 2 days.
No, it would either be tomorrow or Wednesday. It wouldn't be.
Tomorrow is Wednesday.
Tomorrow's Tuesday.
Tomorrow's Tuesday. Well, sorry, I'm really been totally out of it. Let me see my.
I mean, we don't have to. We've done one.
Tell me what you think is going to get people to spend more money.
Well, I think that's just, if you've got something we can trade tomorrow or Wednesday, it's fine. I think Thursday night is just letting him in on, if you can make it special and short, and it doesn't be a long session. I think we go like 45 minutes, half hour at most, with questions, and maybe we end up with an hour session. But in that, I can introduce the link to sign up for the next time. I will do that and help them with the, hey, for the next session, you and I can talk about a script, or not a script, but a presentation. But I'm looking at Thursday night being just because I want people I want as many people to show up. I want to give you a special trade. I think the monthly sounds good. I mean, there's a special advanced trades that come out of this coaching course. I want to add that as a bonus session Thursday night. And please show up then.
Let's do a live trading session tomorrow.
Okay.
Okay. Yeah, Wednesday's no good. I don't like doing them on Wednesday because of OIB.
Okay, so you're going to have a live trading session and then a special bonus session Thursday night.
Yeah. Okay.
And I wouldn't do the homework stuff. I mean, I know what you're saying.
I took it out. I already took it out.
It's just going to make them feel like they've got to. I want people to show up to this, not feel like they've got to do more work.
The trick for tonight will be getting everything done by 7:25. I think I will.
I'm just. Well, if you cut out the other stuff, just don't worry about the
it's not that. Stuff. It's just I really didn't like the sequencing and the stuff from performance, and as I said, I made things too. You know me. I made things too complicated, and simplifying things is hard when you're still trying to drive people to a specific place, and the specific place I'm trying to drive them is to measure cash. Keep an eye on your portfolio, but measure cash. And when I delivered the presentation in the dry run, it didn't come out. So I'm gonna reorganize some things, but it'll be fine.
Okay, send John and I both the slides
sure.
when you get them. Yeah,
well.
Okay, he'll probably be on about 5 after 7 with the things.
I think I got the invite. It was everything goes in my spam filter now, but
Yeah, no, he sent it out.
let's see.
And
Well,
he'll run the survey, and you've got the questions from people, so that's what you're going to do. That's what you're going to do in place of the market.
That's weird. Let me go to my spam box.
You got an already one from me, but now that I found I had to do this, he's sent you another one, brand new one.
Webinar invitation, Dave Durham. That's the 531. That's the 731. There it is. Okay.
Okay, got it.
Yeah, and yeah, I'll clean this up, and I think your feedback was very good on the.
Hello. Hello. Hello.
You there?
Yeah.
Sorry, it's my bad. I hit the wrong button. In terms of do you want me to put on a leap call trade? You know, I toyed around with it with U.S. Steel, and I explained it to people. Do I put it on Thursday? Do I put it on tomorrow? Is it appropriate to put it on to tease people? Would it be too obvious that I'm teasing them into the
next I would do something, whatever you think could be special for Thursday night.
Okay.
So you can get them back. And then tomorrow can just be a regular trade. I mean, it could be.
Okay.
Yeah.
Okay.
Teaching trade.
Okay.
All right.
Did you read the recap stuff that I sent you yet?
Yeah, but I didn't focus on a lot of things. I'm still writing the survey.
Don't worry about it. Just want to make sure I got everything.
Yeah, John gave me some things in the survey, so I'm just cleaning that up right now with what you gave me yesterday. So I'm going to lock that down.
Okay, I'm going to go clean this presentation up. I'll see you later.
Okay, thanks.
Bye-bye.
Bye.